You spent decades building three different buckets of money: a taxable brokerage account, a traditional IRA or 401k, and a Roth IRA. They all grew. They all look good. And now retirement is here, and someone asks you a simple question. Which one do you pull from first? You pause. Because nobody ever told you. The whole conversation for 30 years was about getting money in. Nobody sat you down and explained the order for getting it out. And the order matters more than most people realize. Pull from the wrong bucket at the wrong time and you hand the IRS more money than you need to. Pull in the right order and you could save yourself tens of thousands of dollars over a retirement. This video is going to give you the full picture: the conventional order, why it works, and the situations where you should break it on purpose. Let's get into it. First, let's understand why the order matters at all. Each of your three accounts has a different tax treatment. Your taxable brokerage account holds investments you already paid income tax on. When you sell something that has grown, you pay capital gains tax on the profit. Long-term capital gains rates in 2026 are 0%, 15%, or 20%, depending on your income. Most retirees fall in the 15% bracket. Your traditional IRA or 401k holds pre-tax money. Every dollar you pull out is taxed as ordinary income at your regular bracket rate, which in 2026 ranges from 10% all the way up to 37%. Your Roth IRA holds after-tax money. It grows tax-free and comes out completely tax-free. No tax on the way out at all. Three buckets, three completely different tax outcomes when you tap them. The sequence you choose determines how much of your own money you actually get to keep. Here is the conventional order that most financial planners start with: taxable accounts first, tax-deferred accounts like your traditional IRA second, and Roth last. The logic is straightforward. You pull from taxable first because the tax you pay there, capital gains rates, is usually lower than the ordinary income tax you would pay pulling from the traditional IRA. You let the IRA keep growing tax-deferred for as long as possible, and you protect the Roth until the very end because it is your most valuable asset from a tax perspective. Money in a Roth grows tax-free forever and never forces a required minimum distribution on you. So you want that bucket to compound as long as possible before you touch it. Let's put real numbers on why this matters. In 2026, a married couple filing jointly can have up to $98,900 in taxable income and pay 0% federal tax on long-term capital gains. So if their taxable income is below that threshold, they can sell appreciated assets from the taxable account and owe nothing on the gains. That is a powerful tool. By pulling from the taxable account first in low-income retirement years, a couple in that situation is essentially harvesting gains tax-free. That is not a loophole. That is the tax code working exactly the way it is designed to. Most people just never take advantage of it because they do not know the threshold exists. Meanwhile, the traditional IRA is sitting there growing. Every year you delay pulling from it is another year it is compounding without being taxed. And the Roth is growing completely tax-free with no required minimum distributions ever forcing your hand. The conventional order protects both of those buckets for as long as possible. Now here is where it gets more interesting. The conventional order is the right starting point, but it is not always the right answer. There are specific situations where breaking the conventional order intentionally saves you significantly more money over time. Let's walk through the three most important ones. The first is Roth conversions during low-income years. When you retire and before required minimum distributions begin at age 73, your taxable income often drops. That window is your opportunity. Instead of just pulling from the taxable account and doing nothing else, you can simultaneously do partial Roth conversions. Move chunks of money from your traditional IRA into the Roth, pay tax on the converted amount at your current low rate, and then never pay tax on that money again. In 2026, the 12% federal bracket for a single filer runs up to around $57,500 of taxable income. The 22% bracket runs from there up to about $115,000. If your income in retirement sits comfortably in the 12% range, converting traditional IRA money at 12% to avoid potentially higher rates later is often the right move. This is not pulling from the Roth early. It is filling the Roth strategically while the tax cost is low. The second situation where you break the conventional order is managing your Social Security taxation. As we covered in the Tax Torpedo video, once your combined income crosses certain thresholds, up to 85% of your Social Security benefit becomes taxable. Every dollar you pull from a traditional IRA pushes your combined income higher and potentially triggers more Social Security taxation. In some cases, pulling from the Roth instead of the traditional IRA keeps your combined income low enough to reduce or avoid that torpedo entirely. Roth withdrawals do not count toward combined income. Traditional IRA withdrawals do. That distinction can be worth thousands of dollars a year in reduced Social Security taxation. The third situation is required minimum distributions. Starting at age 73, the IRS requires you to pull a minimum amount from your traditional IRA every year, whether you need it or not. The amount is based on your account balance and your life expectancy factor from IRS tables. If you have not drawn down the traditional IRA much before 73, required minimum distributions can be large enough to push you into a higher bracket, trigger more Social Security taxation, and even affect your Medicare premiums through something called IRMAA, Income-Related Monthly Adjustment Amount, which adds a surcharge on top of your standard Part B and Part D premiums if your income exceeds certain thresholds. The whole point of the Roth conversion strategy in earlier retirement years is to reduce the traditional IRA balance before required minimum distributions force your hand at a potentially worse tax rate. So here's the practical framework that ties all of this together. In early retirement, before required minimum distributions begin, your default is to pull from taxable accounts first. While you are doing that, look at your total income for the year, see how much room you have before hitting the next tax bracket, and convert that room from traditional IRA to Roth if it makes sense for your situation. You are living on the taxable account while quietly reshaping the tax picture of the other two. Once the taxable account is drawn down, or once required minimum distributions begin, you shift to the traditional IRA. And the Roth comes last, used for large one-time expenses, healthcare surprises, legacy planning, or simply kept growing tax-free for as long as possible. There is one more nuance worth naming. If you have a year with an unusually large expense, a major home repair, a medical bill, a car purchase, the Roth is a clean, tax-free source of funds that does not add anything to your taxable income. Using it strategically for those spikes rather than pulling a large chunk from the traditional IRA and spiking your bracket in that year is a smart move. The flexibility of the Roth is part of its value. It does not have to be the last thing you ever touch. It just should not be the first thing you reach for by default. The drawdown order is not complicated once you understand the logic behind it. Taxable first because the tax rate is lowest. Traditional second while converting chunks to Roth during low-income windows. Roth last because it is your most tax-efficient money and it has the least pressure on it. The retirees who get this right do not necessarily have more money than the ones who get it wrong. They just keep more of what they already have. That is what smart sequencing actually is, not earning more. Losing less to taxes over the decades you will spend in retirement. If this finally made the order make sense, share it with someone who is heading into retirement still guessing at which account to tap first. Hit subscribe while you are at it because we are a small channel working toward our first 1,000 and every subscriber genuinely matters. Thank you for watching, and I will see you in the next video.